Hi and welcome to SoMax FinTech Weekly Market Insight. We have changed things around. We are just now doing two videos, and the first one is sort of a brief look at sort of the highlights of last week, straight into the macro outlook, and followed by the second part, which is our chart analysis as usual. So we just condensed it down. We don't think that you're really that interested in sort of what happened last week from the feedback that we are getting. And of course, everybody looks at sort of the various data providers for what's coming out in the coming week. So I will still mention things from time to time. So hope you enjoy it and it's hopefully easier listening for you. As usual, we start with our disclaimer. So trading involves the potential risk of loss of capital. It's not suitable for everyone, although hopefully it is for you. When it comes to leverage, just be careful because you can lose substantially more than that initial investment. Everything we include in here is just purely for educational purposes. We're not trying to provide you with advice. We're just trying to help you prepare, understand the markets better. To help you make better decisions, but of course, if you are looking to invest or trade, that has to be your decision. And before you make that, you should consider your financial situation, your level of experience, and your risk appetite. And of course, on your risk capital, you're prepared, but more importantly, can afford to lose. If you've got any doubts whatsoever, seek independent financial advice before risking your capital. Okay, so last week was a very eventful week, grand finale almost to the year, and what an exciting week it was. We just had pretty much the end of 2023, and we've ended it on a positive note. We know that the interest rate cuts are coming in 2024. We just don't know how quickly or how many. And of course, with economies diverging, that in itself is going to make you sort of have to look at different areas with a different light. And just remember, it's not all about interest rates. So although Powell sort of sounded the most dovish, I just still feel traders are perhaps getting a bit ahead of themselves on how far these rates are going to come down and how quickly. Now, the Fed needs to see inflation hit 2%, and for me, they're going to want to see it stay there as well to prove that it's going to level out at that area. And remember, for the Fed, it's almost sort of like an average. So, they're going to want to see that. At the moment, they're still not getting that. And as I've said in the past, the closer it gets towards that 2%, the harder it is to achieve it. So, those rate cuts will be slow, and the idea of that is because they're not going to want to boost demand too much. So they're going to be very calculated, maybe gapped out even. So they're going to be cautious. They're not going to sort of want to boost demand again very quickly. Now, we are seeing inflation coming down, but, one of the benefits is lower energy prices. They are playing their part at the moment. So while we're still focusing on the US, that the potential for a soft landing, or possibly even at the moment no landing at all, is a possibility. And of course, what we've got to remember is as we go into 2024, it's election year. Now, traditionally, that is a positive year for markets, and of course, if as Biden seeks his re-election, then lower inflation, lower interest rates, they're going to be needed really for him to stand any chance against Trump, if indeed it is going to be a repeat of the last election where it's Trump versus Biden. Now, as I keep mentioning in past weeks, all the COVID related stimulus that came out in the US, central banks and the government as well, they're still economically far above any other country as far as I'm concerned. Very close on their tails, I would say, is India, and for different reasons. But again, maybe that's under most people's radar still. So it's definitely something to look at if you're looking for investments. So that sort of pretty much was Powell's coming out a little bit more surprised with that dovish statement, really. But I'm not sure I believe all of it. Now, the ECB and Bank of England were less positive about lowering rates and about the economies, and obviously inflation is dropping slower in Europe. And overall, I would say that Europe's economy is and remains weak. And next year, I think the central banks in Europe may have to decide between accepting inflation above their 2% level and cutting rates, or face the consequences of a recession. It's all to play for still, and it's going to be an interesting year. These rate cuts will come. It's just a matter of when they're going to come and how many they're going to be. What is the final rate cut decision overall going to be, between 2024 and probably 2025 as well. I don't think it's as clear cut as it's all just next year. But, if traders are expecting the 0-2% rates to come back, I think they're in for a surprise. For me, I think maybe you might get to 3.5% ultimately, but I don't see them really coming down much more than that unless there's another major crisis. And of course, that is always a possibility. We've got these sort of geopolitical issues still going on. And, that's got the potential to cause a surprise yet, I would say. Israel with obviously Hamas, that's still ongoing. And then the older of the two wars with Russia versus Ukraine. And is there any foreseeable outcome in the near future? And the chances are probably not. It just still surprises me that commodities have been so sort of relaxed about these issues so far. But of course, who knows what sort of 2024 is going to bring, or possibly any other friction around the world. Now, many corporations have enjoyed higher profit margins over the last year, 18 months. And, I was just reading this last week, it's amazing that Apple's valuation is actually higher than all but the 6 top major exchanges. And of course, as long as these Titan stocks continue to perform, there's little chance for indices to drop in any meaningful way next year. Of course, that's obviously dependent on recessions and interest rates. But of course, these Titan companies are so cash rich that higher interest rates actually benefit them because they're obviously putting that money on deposit and earning from it, whereas 18 months, 2 years ago, they wasn't really getting much in the way back for all those dollars on deposit. Talking of the dollar, so the dollar bears have been back in, especially after Powell's comments last week. And, okay, US yields have dropped, but I just think that there's so much more to consider just than interest rates and yields. The fact that it looks as though the US can afford to drop those rates is because they've got closer to getting inflation under control than Europe. They've also got that strong economy. I would say probably the two areas of weakness for the US are sort of their higher debt levels, right across the board there, especially at government, $34 trillion almost. And for me, I just still can't understand this weak political system that they sort of haven't addressed yet. The fact that the number one economy can go into these sort of shutdowns or the risk of shutdowns just surprises me. Why don't they get together? Because over time that they both get into power one after the other. So why don't they just come up with a bipartisan agreement that, the debt ceiling and the budget ceiling will increase by X percent naturally each year. And then, of course, if it needs to grow any more than that, then, do that horse trading and work out how to do the rest of it. But at least that's going to keep the government open. At least it's going to keep the country going. And, it's a positive for the US. So, I don't want to drone on about politics because I find it personally really boring. But this situation impacts the market. So it's something that I just wanted to mention. And of course, sort of that impacts the dollar as well. But as I say, if you look economically at the US, they've got the best economy. They're the strongest economy. Yes, they put so much stimulus in there, and that's sort of helping. But when you look at sort of their peers, they're nowhere near them. So if you look at Europe, for example, they do have the potential to keep those yields a bit higher. But personally, I still doubt that because they are going to have to make this decision possibly between accepting a little bit higher inflation because it's going to be stickier, it's going to be more difficult for them to get down, or allowing for a recession. And overall, it's still going to drive demand lower. Again, for me, okay, higher interest rates certainly don't help unless you're a saver. But on the other side of that as well is I think it's prices that's reducing demand as much, if not more. And of course, that impacts disposable income. So sort of rate cuts next year, I think, are pretty much a given in certain countries. As I mentioned earlier, the big question is how far are they going to fall in 2024 and also in 2025. Just a couple of other things. So, my focus is going to be on debt levels next year, employment levels next year, because I think they're going to come much more into focus. China just announced that they're adding a record amount of stimulus, so that's something to keep an eye on as to whether that works or not. I mean, it gave the stock market there a little bit of a bounce. So, but will that feed into the economy? Will that help? Because they've still got issues with local government debt and also the construction industry, the real estate industry is still suffering at the moment. But of course, if they do get going and that does increase demand from China, that could benefit Germany. And obviously, where they're usually one of the strongest nations, they're probably one of the weakest links in Europe at the moment. Now, OPEC. So obviously, when we look at those oil prices, it must be a massive surprise for them to see them at the low 70s and even touching into the high 60s over the last week or two. And it just seems that OPEC and even OPEC Plus, their grip on oil has weakened. Now, it is important to, take into account that they only actually account for 40% of global oil exports. And now I think, what's also having a big impact is the fact that the US now are producing a lot more oil again. And therefore that's having a bigger influence because they are prepared to release that oil. In 2024 they will start to rebuild their stocks in their strategic reserves. Sorry, struggled to get that one out. But again, it's going to be a really interesting 2024. So that sort of pretty much covers this side of the things. Then now in part two, we just go straight into the chart analysis. So we'd love your feedback. This is the feedback that we've been getting, that perhaps it's all a bit too long, and you guys obviously are in the market, so you know what happened last week. You can all go into investing.com or FX Street and see the data for this week, or lots of other websites. And even Financial Juice, where of course with them you can even get the squawk, where you can listen to news as it breaks, which is a great thing. We as pro traders have been using that for decades, where we use a squawk. So anyway, hope to see you in part two. So just moving on to highlight what we do as a company. Obviously, the majority of you are probably familiar with that, but there's always some new people viewing these. So it's just to give you a little bit of an insight into Cymax FinTech as a company. So apart from the YouTube, we provide daily newsletters, which include sort of global headlines, global news, and then as an option, there's fresh chart levels and pivot points each day. Then when it comes to sort of workshops, if people are looking to get into trading, then our sort of introduction to trading is a great one. Trading for beginners. And then for others that are already trading but have got gaps in their knowledge or their trading skills, then we can help you with those as well. We do offer 1 week courses. They can make you feel competent and confident in just 1 week. Does it make you a trader? No, but does it give you the foundations on which to build your trading career? For sure. And if you've got that inner trader, I will find it. And of course, now you have the option of going for one of our new course, which actually includes a free trading challenge attempt as well. And then if you're really serious about making trading your career, then our comprehensive accredited masterclass is the one for you. It's designed to provide you with all the knowledge and trading tools required to navigate any market conditions, and also any asset class. And the next one of those starts on the 19th of June. So you've got a week to register if you're interested. Then trader mentoring, some people don't want to go through courses, but they do need help still, and I can certainly do that. Consulting, we consult to companies around hedging FX and commodity exposure. And then of course we provide a mass of educational content that can be to individuals, exchanges, to brokers. And as I just mentioned, if you're looking for that funded account, maybe you're a bit sort of undercapitalized, or possibly you just don't want to use your capital, then there's the opportunity to go through the challenge and hopefully qualify for a funded account through one of our partners, Nordic Funder. If you'd like to contact us, it's info@cymaxfintech.com. Any questions you'd like to aim directly at me, it's chris.tubby@cymaxfintech. Sorry, go back to that one, christubby@cymax-int.com. Just get so used to the fintech part. And of course, look forward to seeing you in the second part.